With all 6 national banks forecasting yet another rate hike on Wednesday, this is only going to add further stress to existing variable rate holders, but also the fixed rate borrowers when it comes time to renew their mortgage. I'm one of them.
The Bank of Canada announces a rate change this Wednesday, widely expected to be a move to 5%, the highest it's been since 2001. Mortgage brokers say at this point there's really not much more borrowers can take.
The cost of mortgage borrowing has increased close to 70% since the Bank of Canada's initial increase in this rate hike cycle. I think when it comes to the direct impact on Canadians from previous rate hikes, more than 3/4 of people with those variable rate mortgages have already hit their trigger rate, even before the June increase. And this comes from a recent Desjardins report.
Lauren Vandenberg with Mortgage Professionals Canada says it's past time the federal government intervened. She suggests a permanent national housing roundtable, reintroducing 30-year amortization periods for insured mortgages, and eliminating the stress test for people transferring, switching, or renewing a mortgage, noting those people were already stress tested when they first applied for a mortgage.
Look, I'll be frank, the biggest expense for Canadians across the country each and every month is keeping a roof over their heads. And we are in a housing affordability crisis.
The reason for the sustained price increases, or not so much of decline in prices, is because we do not have enough housing supply in Canada.
Murtaza Haider is a professor of data science and real estate management. Haider says the core problem in Canada's housing market remains lack of supply. He notes that while the Bank of Canada is pulling the only lever it has to control inflation, raising rates also has the unwanted effect of making business harder for builders who may be borrowing to start housing projects.
If they have made their business models based on an interest rate of 1% or 2% or 3%, and now they're in the interest rate regime where the cost of borrowing to them is between 5 to 10%, then their market analysis or their business models will not work to build those projects that they had proposed or even were approved to build.
In Ottawa, Xiaoli Li, City News.